Hello everyone, welcome back to this week's Technical Insights. Major US indices ended last week in the green after we got more clarity on President Donald Trump's tariff plans. The latest US CPI and inflation data last week were also constructive as a whole, even though we saw a slump in retail sales for January that was worse than economists estimate. In the middle of the week, the US CPI data rose by 0.5% in January, above the expectation of a 0.3% increase. The US Producer Index also rose by 0.4% in January, above the 0.3% increase expected by the market. And then on Friday, retail sales in the US fell by 0.9% last month, larger than an expected of 0.2% drop amid the declines in most categories. The Dow Jones Industrial Average decreased 0.37% or 165 points to close last Friday at 44,546 points, while the S&P 500 was relatively unchanged and remained at 6,114 points. The Nasdaq Composite Index rose 0.41% to 20,026 points. Consumer staples and healthcare were the biggest drop among the sectors, while big tech stocks outperformed again. For the trading week, the Nasdaq Composite Index jumped 2.6%, while the S&P 500 advanced 1.5%. The Dow Jones Index also added 0.6%. So as a whole, it looks like the economy and inflation are not accelerating very fast and keeping interest rate in check. The 10-year Treasury yield also continued to slide on Friday, dropping nearly 5 basis points to close at 4.478%. US market will be closed tonight in observation of President Day. In Asia, Hong Kong stock advanced nearly 4% on Friday as a less aggressive US approach to reciprocal tariffs and continued enthusiasm for Chinese tech firms put investors in a buying mood. The Hang Seng Index surged 3.69% or 805 points to end at 22,620 points, while the Hang Seng Tech Index jumped 5.56% or 290 points to close at 5,526 points. Chinese tech stocks continued to gain momentum as the global success of DeepSeek fueled a growing interest in the country's AI capabilities and advancement. Shares of Tencent and Xiaomi soared over 7% last Friday, while Alibaba and Meituan also gained 6% each. Beijing is doubling down on AI as a national priority, and investors are rushing to reprice China tech stocks and innovation potential. So this may no longer just be a stimulus-driven bounce, and the Hang Seng Index could finally break out of its multi-year slump. For the trading week, the Hang Seng Index jumped 7.04%, while the Hang Seng Tech Index rose 7.3% to a 3-year high. This will be Hang Seng Tech Index's 5th consecutive weeks of gains and the best winning run post-COVID in late 2022. Global investors are also starting to reassess China's investability within the tech and AI space, which could lead to a further recovery in Chinese tech stocks. And Chinese President Xi Jinping also planned to chair a symposium attended by Jack Ma and other Chinese business leaders next week to boost private sector sentiments. Back to Singapore, our STI index closed lower on Friday, despite the latest economic data showing that our country economy expanded by 4.4% year-on-year in 2024. The STI finished low by just 5 points or 0.13% to close at 3,877 points. Last Monday, the STI formed a fresh all-time high at 3,921 points before closing at 3,875 points. For the trading week, we are up about 16 points or 0.42%. And the STI gain this week bring the year-to-date return for the index to 2.6% versus a 1.1% in Sing dollar terms for the FTSE APAC index. This is in contrast to the year-to-date 0.6% decline in the returns of the IHS REIT index. And for the 3 local banks, the average year-to-date return stands at 3.9%. Earlier in the week, DBS reported a record net profit of 11.4 billion Sing dollars for its FY24 ending 31st December, up 11% from FY23 with a ROE of 18%. DBS Bank plans to manage excess capital over the next 3 years with a capital return of dividend 15 cents per share per quarter in 2025. Similar amounts are also expected to be paid out in the following 2 years through various mechanisms. DBS board continue to explore all forms of capital returns to shareholders, and DBS CEO and Deputy CEO expect that FY25 net interest income to be slightly above FY24 levels based on 2 rate cuts in second half of this year. The banks also expect the non-interest income growth to be in the high single digits, led by growth in wealth management fee and Treasury customer sales. Meanwhile, UOB is expected to report on February 19, with OCBC scheduled to report on February 26. So for this week's technical analysis, let's look at local bank DBS. Last Monday, DBS share price hit a new all-time high of $46.50 over here. It was up 70 cents or 1.57% for that day before closing at $45.38. For the trading week, DBS share price rose a modest 16 cents or just 0.36%. So is DBS still a buy after dropping 22 cents last Friday to close at $44.84? The previous time we covered DBS was on the 13th of January period, and you can click on the link around this video to rewatch that video again. And previously on 13th of January, we concluded that the MACD indicator and the RSI were signaling weak uptrend momentum, and investors can be patient to accumulate DBS shares around the 20 days moving average or the 50 days moving average at 43.89 cents and 42.72 cents respectively. On 21st January, DBS share price hit a low of $43.12, and that triggered the first support level of the 20 days moving average at $43.89. The 50 days moving average in blue then moved up to $43.40, giving DBS share price a firm support during that period. Subsequently, DBS share price rebounded very strongly and hit a high of $46.50 last Monday on the 10th of February. Looking at the chart now, DBS last closing price at $44.84 is still higher than the current 20 days moving average at $44.22. And the next support level could be back to the blue line, which is the 50 days moving average now at $44, with the lower bound of the Bollinger Band now at $43. Looking at the indicators now, the MACD reading has been coming down since last Monday. And as the MACD converged towards the signal line, this indicates that the uptrend momentum that we have been observing in the past few weeks is actually subsiding. The latest RSI reading was 57 points and is still a healthy reading above the 50-point neutral mark, signaling that the uptrend is still intact but was lower than last Monday reading of 66, echoing MACD indication that the uptrend momentum is also slowing down. So with both the MACD indicator and the RSI signaling that the momentum is likely to slow down further, investors can wait for a pullback again towards the 20 days or the 50 days moving average at $44.22 or the $44 level before accumulating back on DBS shares again. Based on 20 analysts covering DBS in the past 3 months, 9 of them have a very strong buy call and 2 of them also have a buy call. 9 of them has a hold call and there are no sell recommendations. The 12-month average target price for DBS now stands at $48.20, with a maximum estimate of $53.70 and a minimum estimate of $42.75. And these are the updates that I have for you this week. If you find the information useful, do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you again next week in the next Technical Insights.